Hello, everyone, and welcome to Brady Ware's webinar covering expiring state tax provisions and their potential impact. Joining me here today is Mark Hassens, a fellow shareholder who leads our estate, gift, and trust practice. Also joining me is Adam Titus, also a fellow shareholder and a leading tax expert. Thank you, Mark. Thank you, Adam, for being here today. I appreciate it. My name is Anita Anand, and I'm Brady Ware's managing shareholder. I appreciate everyone joining in today. In scanning the attendee list, it was really encouraging to see a lot of familiar names. So I'd like to thank our clients for taking the time to listen in. It's also very encouraging to see a lot of new names. So we welcome you all to Brady Ware's webinar. And for those of you that are maybe somewhat unfamiliar with Brady Ware, our focus for over 70 years has been to provide business owners and high net worth individuals with tax, accounting, and advisory guidance and support. So, of course, we assist with the traditional tax and accounting questions and issues as they come up. But as trusted advisors for our clients, many times we find ourselves helping with what I'm going to call the more intangible issues that can sometimes be even more challenging than some of the traditional tax and accounting issues. One of those very issues is assisting business owners with succession planning and helping them understand maybe what financial strategies may be available to them and helping them understand and make the decision on which ones are probably the most appropriate for them to incorporate into their planning. So that kind of helps tie us back to the topic at hand. The estate and gift tax exemption is something that we've been working and talking to a lot of our clients about, helping them understand the landscape, helping them understand the parameters. Why are we talking about this now? So that they can understand what planning opportunities may be available to them and help them capitalize on those opportunities. But this whole series of domino effects really kind of got kickstarted back in 2017 with the Tax Cuts and Jobs Act. That piece of legislation ushered in all kinds of changes that impacted not only businesses, but also individuals. And one of those changes is the estate and gift tax exemption, which is now looming over the horizon. So, why are we talking about it today? The expiration of this exemption could reduce wealth transfer by up to 40%. So it's a big deal and can have a material impact on your overall estate plan. It's set to expire December 31st, 2025. So with that, we've been talking to, like I said, a lot of our clients, and the reason we're having this webinar today is to try to get the knowledge and the information out there for everyone to understand what your options are to ensure that you're maximizing any planning opportunities that are available. Before we get into the core and the crux of our discussion today, I'd like to have Mark and Adam introduce themselves for just a moment. Adam, if it's okay, if I'll have you go first, and then if you can kick it over to Mark, and then Mark will introduce himself, and then maybe even set the stage a little bit from where we'll pick up and continue our discussion. Adam, over to you.
Yeah, thanks, Anita, for the introduction. Anita kind of gave the background a little bit. I'm a shareholder with Brady Ware. And I think just, in talking about this stuff, I think one thing that we really enjoy as a firm is just working with clients, whether they own a business and like working through that entire life cycle of the business, or even as an individual, as we talk about estate and gift planning. I think, it's really important to stay on top of things and focus on things. Now, while the presentation is focused mainly on the estate tax provisions, we'll cover some other provisions that will be expiring in the next year. So thank you for joining us here today, and I'll kick it over to Mark.
Thanks, Adam. I'm Mark Hassens. I'm also a shareholder at Brady Ware, and I lead the firm's trust and estate practice area within the tax services group. And as Anita just touched on a few minutes ago, we're here to talk about the sunsetting of the lifetime exemption for estate tax purposes from the $13.61 million that it is today down to about $7 million on January 1, 2026. So the Tax Cut and Jobs Act of 2017 was a really great piece of legislation for us. It created a lot of work, but it was passed as a budget reconciliation bill. So without that super majority in the Senate, that bill has to be budget neutral or deficit neutral after that 10-year budget window that they use. So to bring down the overall projected cost of a permanent bill, Senator Hatch proposed an amendment to the bill, which added the expiration date for the individual tax provisions. And that's the bill we have today to work with. So prior to 2018, that lifetime exemption was $5.49 million. And with the passage of the Tax Cut and Jobs Act, it went to $11.18 million. And that is indexed for inflation. So Just as a quick current event note, last week on October 22nd, the IRS released next year's inflation adjusted amounts. So for 2025, the lifetime exemption will be $13.99 million. The annual exclusion for gifts will be $19,000 per person. So present interest annual gift exclusion is increasing from 18 to 19,000 per donor or per donee. And that, in my opinion, that little tidbit should be worth the price of admission today. So early on in the life of the Tax Cut and Jobs Act, the IRS gave notice that they would not claw back the excess exemptions used when it does reset. So what that means is we're able to use $14 million of the exemption now, and after it resets to 7 million, it's done. Once it's done, it's done. So they're not going to claw back that additional tax that we kind of cheated them from. So how do we do that? Well, the important thing to understand is that we have options. And what we ultimately recommend, it really depends on what your wishes are, what your goals are for your wealth and for your heirs. For instance, you could just decide today that I just happen to have $13.61 million in my checking account right here. I'm just going to write checks to my heirs and get it over with, use that exemption. That's perfectly fine, absolutely fine. However, some might not look favorably on that. They might not really view their beneficiaries as able to make good decisions. And they might not be of age to accept that kind of money, or they might not act like they're old enough to accept that kind of money. There could be other family dynamics at work that would dissuade you from giving assets away directly to your beneficiaries. So what you should consider overall is what's the likelihood of your beneficiaries making a bad decision, and how does that increase if they have the financial wherewithal to finance those bad decisions? So instead, I would suggest using irrevocable trust to hold and control those assets so the beneficiaries don't have that ultimate control. Revocable trusts don't work. That you can't transfer it now, claim the exemption, and then change the terms of the trust down the road. That's not what we're talking about here. What we're talking about is giving up dominion and control for the assets. So we have a few options when it comes to what kind of irrevocable trust that we use as far as income taxes go. We could use a trust that pays the income tax on that income that the trust owns, or the trust earns through the year. Or we could distribute out that income to the beneficiaries, and the beneficiaries would then pay the income tax due on that income. Or we could set up a grantor trust that would allow the assets to remain in the trust and grow tax-free as far as the trust is concerned, because the grantor is paying the income tax due on that income from other assets outside of the trust. As an example, one of the trusts that we use to accomplish these transfers, and one that's kind of in vogue right now, is an intentionally defective grantor trust, or an IDGIT. So we use these for gifting and also to accomplish estate tax freeze. So a freeze is when you stop the appreciation of an asset within an estate. So let's say we have a small business worth $10 million and it's growing at 10% every year, and we want to sell it to an IDGIT. So for this transaction to be considered on the up and up, we need to have an adequate non-leveraged asset in this trust to kind of back up the sale part of it. So we gift $1 million of this $10 million asset and then sell 9 million more. Okay, so that $9 million sale is in exchange for a note. So we've removed that appreciating asset and replaced it with a note receivable that's really going down in value because the principal balance is being paid off, and it's being paid off from the income of that business. So the income from the business goes in, the note payments are made out to the grantor. The excess income would stay in that trust and then could be reinvested in other assets to really grow that trust exponentially by the time the grantor passes away, hopefully. And all of that is estate tax free because we've used the lifetime exemption. One of the other trusts that we use first thing about that small business, closely held business that goes into that trust, we have to have a valuation done on that, right? So those valuations can also calculate a discount for lack of marketability, a discount for lack of control. So maybe instead of a dollar for dollar transfer on the overall enterprise value, what we're really doing is getting a 65% or a 75% share of the overall value. So you can get those discounts up to 30, 35%, whatever. I'm not making any promises of what that value might be. But you're not getting a dollar for dollar gift or dollar for dollar sale because it's a small business, a closely held business. And then let's go on to just one other example, and then I'll wrap my babbling up here. But another trust that we might use to lock in this lifetime exemption now is a spousal lifetime access trust, or a SLAT. So a SLAT is an irrevocable grantor trust because the dominion and control over the assets has been given up by that grantor. And then the spouse has access to the income, maybe some principal for their lifetime. And then these usually terminate when the spouse passes away, and the trust income and principal goes to the remainder beneficiaries that are named in that trust. And now a few drawbacks of a SLAT. One, it's irrevocable. And two, divorce could be a problem. So these are grantor trusts. So you could be in a position where you're paying tax on income your former spouse has access to. Probably not a good situation for a lot of people. And then also the untimely death of that spouse would also mean that the grantor does not have indirect access to those trust assets or that trust income anymore. So if you're thinking, that SLAT thing, that sounds really great, and I think I'm going to do that, and my spouse can do the same thing, cool your jets. You can't. So you can, but you have to be reasonable with it. You just have to be aware of the reciprocal trust doctrine. So that kind of thing is courtesy of actually the Lehman Brothers. So the Lehman Brothers back in the 1930s, each there were two brothers, and they set up a trust identical, one for his brother, and then his brother set up an identical for one for him. It was to avoid taxes, right? So the IRS came in and said you were in no different position from the time you set up your trust because your brother has the same exact trust signed on the same day. It's a reciprocal trust. You're not out anything. So they unwound them. They threw them out. So now we have this reciprocal trust doctrine that you have to be aware of. So if you are doing two SLATs, then you and your spouse, there should be some time in between those. Change some provisions, trustees, beneficiaries, to avoid that reciprocal trust doctrine. And then I think that's pretty much all we need to go into now. So the IDGIT and the SLAT, they're really two of the most common examples of what we use to take advantage of that higher, soon to be $13.99 million exemption before it sunsets December 31st, 2025. You've heard enough from me for now, and I'll throw it to Anita.
Appreciate it, Mark. No, that's great. As you were talking, it just kind of makes me think, leave it to us tax nerds to come up with all kinds of these acronyms, IDGITs and SLATs and all kinds of things, right? We've got to keep something exciting on our day-to-day basis. But no, that really helps set the foundation. I'd like to get a little bit deeper into some of the things that you've just kind of touched on and even address maybe some what I'm going to call common questions and issues that we have been working with our clients on. But before we go into that, just want to remind everyone, if you do have questions, we will be accepting questions throughout the webinar today. So if you do have questions, please go ahead and submit them through the Q&A chat. I will be monitoring questions as they come in, and we'll try to address those questions throughout our discussion today. But if we run out of time and your question was not answered, please don't feel like you lost your opportunity. We'll be keeping track of what we have answered, and what we haven't, we'll definitely follow up after the fact if we are not able to get to your question in our hour today. So Mark, you mentioned the lifetime exemption. So what if someone has already utilized their entire lifetime exemption in a prior year? What does that mean for them? Where do they go?
Yeah, sure. So because that's adjusted for inflation every year, you can still use that difference between what you've already used and the current year. So for instance, if you made a gift to maximize your lifetime exemption back in 2023 when it was $12.92 million, it moved to 13.61 in 24. So you can make up that difference. So $700,000 or so difference in between that year, you can do another gift for that amount. And then next year it's going up again to that 13.99 million. So between the 12.92 and the 13.99, we've got over $1
Right.
million of additional transfers that we could take in or transfer before the end of next year.
Gotcha. So it's not like it's a lost opportunity. You can always take advantage of that differential.
Absolutely.
Well, what assets should people be thinking about, in terms of transferring? Because there's all
Right.
kinds of
So
assets out there.
yeah, absolutely. Yeah. So, like the trust that I talked to
Mhm.
earlier, that intentionally defective trust, one, you would want to have an asset that's appreciating. Okay. So you want to win the game. So if you're
Mhm.
transferring a $10 million asset, you want that to grow to $100 million because it's basically growing estate tax free. So we want an appreciating asset. And then if you're using an intentionally defective trust that has a sale component to it, you need that cash flow to make sure you're making those regular payments on that note receivable. And if I didn't mention it before, that note receivable, that's a real note. I mean, that really has to be a valid note. It can't be that I'm making payments when income comes in, kind of, as I want to. It's regular payments that are scheduled out and stated interest. And because that's a grantor trust, it's a non-event for income tax purposes. So that sale, it's not a taxable sale. The interest is taxable interest income. So because it's between the grantor and themselves, basically. So that's not an income tax situation. But to answer your question, appreciating assets would give people the biggest bang for their buck on locking in this lifetime exemption transfers.
Perfect. Adam, I'd like to go over to you because I know you've dealt with this before. What if we've got someone who's got the majority of their value tied to a business? How do they approach this whole planning? Oh, Adam, I think you're still muted.
Right.
There we go.
Thank you, Nita. There's several things to consider when you're looking at, potentially capturing that value and transferring those assets as part of taking advantage of this expiring estate tax, the lifetime exemption. Uh, One of the first things you want to take a look at is the current tax structure. I think a lot of times you get into a structure maybe on formation or something in the past that it's a benefit at that point. Kind of diving into that and looking at what it looks like and transferring ownership in that entity, and whether it's a pass through or a C corp. It's kind of a holistic look at that. Currently, whether or not you're maximizing your tax savings under the current structure, and then what that looks like as you start to transfer value. And then, kind of after taking a look at that, you want to visit, what does your timing look like and your strategy as far as is transferring? And what I mean by that, I mean, do you have, if it's a closely held family-owned business, are there younger members in the family that are interested in running the business in the future? Are they currently able to do so, or is there still time needed to do that? And then, if that's the case, how do you structure that and kind of move forward, based on that timing? If you own a business and you're growing and you're looking at, you kind of have a target date in your mind, but you haven't really thought about what a transaction looks like and what the value is, because you could certainly transfer ownership while you still own it, through the family or other means. Or you could look at potentially a third party transaction. We work a lot with buyers that are out in the market right now that are looking for businesses to acquire that are local to our markets, and we could help to make those connections as a look in that. And that can be a kind of a scary process to work through if you haven't been there before. And so that's where we kind of help you to look at the things that a buyer would be looking at and kind of line up, what needs to be looked at and adjusted maybe to get in that place where you're ready to go to market. And there's certainly, we have to the end of 25 to look at this and to, position someone. So there's a lot of time to go through that analysis. Private equity's been big out there. So, it could be someone local, might be a competitor that may be interested, but also, private equity is an option, or maybe even someone that's in that industry in another market that has been looking to enter the area that you're in. And there's a lot of things to consider. There are a lot of different ways that can be structured that can accomplish different goals. But as far as capturing that value in this estate planning, uh, you just need to look at it holistically because each one of those things play into each other.
Yeah, all good points. And you touched on something, Adam, that kind of got me thinking. One of the things, in my experience, that I feel like is very commonly overlooked is the question about, okay, if I have a business, do I have the generation, below me really wanting to take over that business? I think there's a lot of assumptions that are made by those that are currently running the business that, oh yeah, my kids are going to take over and this is what they want to do. And then you kind of get closer to it. You realize that's not really a viable option. I found that to be something that has been glossed over many times with our clients. Have you noticed that too?
Yeah, I mean, it's something that, because, we're as shareholders of the firm, we're business owners ourselves. And, you can, as a business owner, you can be very kind of focused on the business and the growth and the things you're trying to do day in and day out. And then when you're focused on those things so heavily, things like, an exit plan or retirement, it kind of takes a back seat. Although, I think everyone at some point plans to retire. It's what is that target date and what does it look like getting there? How do I position the business to a place where if you have younger family members, it's great because they're likely already working with the business. You've been kind of moving them towards that direction. But if you don't, you have employees that may be interested in owning the business, in trying to work towards that transition. I mean, there's so many different ways to look at it. But kind of why we're bringing this into the estate discussion. It's to just get your mind kind of thinking about that and looking at it, and then trying to figure out what that looks like, and then maybe get one of us involved to help you kind of coach you through it, as we've done it so many times with other clients.
Right. So you mentioned a potential exit, and that can be scary for a lot of people. Maybe they're not prepared to just fully step away. What options could there be for someone in that type of a situation?
There's several options there. I mean, I mentioned private equity before. Private equity transaction doesn't have to be a complete exit. A lot of times it can be a capital infusion to where maybe you give up control, meaning more than 50%, but you stay on as a minority owner and still run the business, and that capital infusion can help fuel growth. And what happens a lot of time in that scenario is that the initial transaction where maybe you give up 51% or whatever that percentage runs to, the as you get the capital infusion and it fuels some of the growth projects that maybe you didn't have the capital on hand before, 5 years, 7 years down the road, there's a second transaction where you fully exit. And in that time period that, whether it's another company or a PE group that is infused the capital, they help you to also grow your team. Which, a goal in retirement is you basically want to diminish your value to the company so that you can fully retire and enjoy your retirement. And so you do that by growing a team that can kind of replace you. And that second transaction, we've seen it several times where that value ends up being actually higher than the initial value where you gave, and you're selling less of the company at that point. So it can be a really good spot to be in. Another option is, a full exit. Selling now doesn't mean also that you're done either. I mean, you could work out a contract on the backside to where you work to support, for 2, 3, 4, 5 years after the transaction and helping that transition so that you can get full liquidity at the moment. I mentioned earlier, if you have employees that, you have a really great team under you already, and they voiced interest in owning the business in the future. There could be a management team that maybe, does the acquisition, or you could have an employee stock option plan could also be an option where, basically the employees of the company end up in that ownership, and that, this can be somewhat complex to work through. So it's important to get an advisor involved early on to help you work through that.
So you've touched on value a number of times. Can you kind of share for the audience, like how is a value determined? And how does that play into the overall lifetime exemption?
Yeah, so when we're talking about estate and gift tax, the important thing is that you're going to need a valuation completed for your business, and that needs to be completed, as of the date, whatever the transfer occurs. So valuations, they can be a little bit pricey, but Mark mentioned earlier, I mean, the tax consequence of not planning for the transfer and utilizing that lifetime exemption is up to 40% tax rate on the value above the exemption, especially if it gets expires at the end of 25 and it's cut in half. So getting that valuation done is really important. And Mark also mentioned earlier the discounts that are applied to that. So let's say you have a value of a company and it's 20 million. And we know we have for 2024 13.61 million. So that gap would be subject to estate tax. But if you own 100% of it at 20 million, you'd get at least lack of marketability if you're not actually selling the business. Like if you're just transferring it to next generation because you're not actively in the market, you don't know what the true value is. Because the valuation is really an estimate based on market conditions. Now, if you're let's say that you only own 50% of the business, and the value is 20 million in that case, you could get a discount for lack of control and lack of marketability, because you don't have full control over whether or not you could push the sale of the entire business, as far as going to market and fully exiting, as far as current ownership. And so when you talk about that, and you have the gap of between 20 million and the lifetime exemption of 24 of 13.6, you have that gap of 6.4 million. Well, after you apply those discounts, you may only have a million or two subject to tax, 40% tax. So you're saving on the 4 to 5 million that you're getting those discounts on. In the case of full liquidity event where you sell the entire business, those discounts go away, because the value is the proceeds at that point. And at Brady, where we have a valuation practice where we can assist with that valuation work.
So what happens if the law gets extended, right? Let's play out that hypothetical. Is all this a waste of time?
I don't believe so. I don't believe that any of our strategies that we recommend, I don't believe they wouldn't hold up. So it's kind of the do no harm strategy. So let's say you have a lifetime exemption that remains unchanged, and we just transferred $13.61 million this year, and they extended for a couple more years. Well, if that transferred asset appreciates more than whatever those inflation adjustments are for the next few years, then you've won, and you've made a better choice by doing that earlier rather than later. So yeah, I think as long as that appreciation is out of your estate, and you wouldn't have changed those beneficiaries of your trust, I think that it's a viable strategy to do now, even if the law doesn't change. Adam, do you have anything to?
Yeah, I think that's all good stuff that March mentioned, but as we've talked about the piece where Anita posed a question, what if the most of my value is tied to a business I own? I think whether or not the estate lifetime exemption exists at its current level and is extended, of course you get those inflationary adjustments that could still apply, but planning for an exit ultimately on your business is also a big piece of just what you should be looking at and considering over time. So, if the law is extended, you've been able to utilize the lifetime exemption to that point, that's great. You'd have those gaps that maybe are created by inflation in the future, but you could also, that planning on how your business can continue on, whether it's through next generation, family owned, or if it's employee owned, or if you fully exit, and what that timing looks like. It looks like it's always good to take a look at that and if you're early on and owning the business and younger, just revisiting it maybe every 5 years to see because your timeline may change over time. When you start the business, you may think, oh, I'm gonna do this for 30 years, and in 5 years down the road, you may think differently of that, and maybe your interest has changed, or there's something else you'd like to do, and just kind of having that back of mind and knowing that it's something you need to plan for. You may trip into needing to accelerate that at any point. I mean, life comes at you quick, and there's certainly other things outside the business that could impact that. And I think it's always important to know and have some sort of whether it's back, a napkin plan, or, something that you've written down over time and that you can revisit, uh, every 5 years or so, and see how that's shifted and changed over time.
Yeah. I think everyone on the call can appreciate that life does come at you fast, right? We've all been there and done that and felt very overwhelmed, and we're like, why didn't we plan for this before? So Mark, help us understand if these are financial strategies that are viable today, regardless of what happens with the law. Why are more people not doing this? What's the hesitation? What's holding them back?
Irrevocability. So
Mhm.
you can't change it once you do it. And that control, that giving up control is a big, huge step. And that it's a big decision to kind of move forward with. Um, so if you're a person that like if you have let's say you have a living trust now, and you make it a hobby of changing that and amending it every couple months, you get mad at a beneficiary, you drop them out, they apologize, they go back in. If you're one of those people that are constantly changing your revocable trust and really can't decide on the irrevocability part of it, that's a really big um, non-selling point. I mean, that really knocks a lot of people out of the game that want to do this because they don't want to give up that control, and they don't want to sign $14 million of their life away until
Right.
they actually have to.
Yeah, that makes sense. Now, we actually had a question come in through our Q&A on irrevocable trust, so I'll go ahead and I'll insert it here. The question is, if we set up an irrevocable trust now and contribute less than the 7 million, is there any benefit to doing so now, other than not knowing if we will be around tomorrow? Or is the benefit truly only if going to contribute in excess of the 7 million?
Yeah, so there's still a benefit. You're just not benefiting that $2.8 million tax savings by doing it now, but up to 14 million and then seven away from it, that difference
Mhm.
is $2.8 million of tax. So let's say you have an asset right now that's $6 million, okay? And you know that exemption is going to change to 7 million. So you really don't have a taxable estate yet. Well, what if that $6 million asset doubles in value in the next couple of years? What if it goes up 20% a year? Then you do have a problem, and it's going to come at you fast too. So yeah, there is still benefit to doing that because you're locking out that appreciation out of your estate. Now, like I said, these irrevocable trusts are not for everyone, and that's okay too. But if they are for you, if that's really what's important, and you want to protect your heirs, and you don't want the IRS to be one of your largest heirs, then this might be an option for you. But the benefit in your case, or in this case, would be protecting against that appreciation, using up all of your lifetime exemption, and then having excess value in your taxable estate because of that appreciation. You can't go back. So we should have done it 2 years ago when it was only worth $6 million. It's too late then. So if it's worth, let's say, $6 million now, it's going to grow to 9 in 2 years. Then yeah, sure, it makes a difference. It makes a big difference.
Got it. It makes perfect sense. So the estate and gift tax is obviously a big, provision of the Tax Cuts and Jobs Act is looming. Adam, can you give us maybe a quick rundown of what are some of the other provisions that are looking to expire, just to kind of give our audience a little bit of a broader picture of maybe how some other things may come into to some of this estate planning?
Yeah, I think with there's a lot of impact on pass-throughs. A big part of the Tax Cuts and Jobs Act. I mean, they moved I mentioned pass-throughs, but they moved the C corporation tax rate to 21%. And the effective way of kind of equalizing that among pass-throughs is they introduced what's referred to as the qualified business income deduction.
Mhm.
Of course, there's calculations that work into that, so it's not pure to what I'm going to say next, but it's the basic impact of that is a deduction that's equal to 20% of the taxable income, from that business. If it's defined as a trade or business, there's certainly other definitions, but that does expire at the end of 2025. So when I mentioned looking at tax structure and what makes sense, I think, and just for planning, I mean, that's in an S corp where or a partnership where the income is pushed out to the partners or shareholders on K1s, and then there's also cash distributions generally to cover that tax due. Well, as each one of those individuals loses a 20% deduction effectively, the cash outflow for taxes will be higher. So there's some planning that needs to go into the business on just cash flow throughout the year and how that may impact operations. Another provision that it's at the individual level, but it impacts pass-throughs was the state and local deduction for itemized deductions. That, prior to the Tax Cuts and Jobs Act, so 2017 and prior, you could deduct state and local taxes on the individual return, but it's capped at 10,000 for 18 going forward, including for 24 and 25. In 26, that $10,000 cap is now gone. And one thing that several states introduced as a workaround so that the deduction and that value, that federal tax savings would still be available, is that you could elect to pay that state tax at the entity level. And so you get, that state tax is paid at the entity and it's deducted. And, every state did those a little bit differently, but you get a credit basically that passes out to the individuals that then satisfies their state tax liability at the individual level. So those, I assume that the states will continue to do that because it does kind of simplify at least the tax collection, where the entity is paying one tax to cover several partners or shareholders, whether it's a partnership or an S corp. And so I expect that to continue on as a benefit there, but it can change maybe the way you view it and just the analysis in looking at whether or not there's still a benefit to doing it, which could be different on a case by case, and that's mainly due to the way that the states may do that pass-through entity return differently. Another impact, which we've already seen, some of the impact of that is on bonus depreciation. The Tax Cuts and Jobs Act renewed that 100% bonus depreciation on any qualified property placed in service, and that was 100% through the end of 22. And then, part of the expiring provisions is, Mark pointed out earlier, how they kind of balanced the budget on the benefits versus the tax inflow, over time. They're reducing that bonus depreciation each year by 20%. So in 23, we saw it go to 80% bonus. 24, it's at 60%. 25, it'll move to 40%. In 2026, it moves to 20%. And then in 2027, bonus depreciation is gone, absent any renewals or changes in tax law. So we still have Section 179 out there that we can elect to expense assets, but there's a cap, on that based on additions, and there's a dollar for dollar reduction over that cap. So there's planning there for cash outflow for taxes as those accelerated methods will change going forward.
So this Tax Cuts and Jobs Act is causing all kinds of frenzy everywhere. If you can, Adam, if I can ask you to shift your focus now, because I know a lot of those that are on the call today do have businesses, and so they're trying to put all these pieces together. But now if you can shift your focus to more individual focused provisions that are also potentially expiring, that would be great.
Yeah, I mean, as far as individuals, I'll start off with two things and they kind of intertwine. I mean, I talked about with the pass-throughs with the state and local tax deduction, how that was capped at 10,000, and that goes away at the end of 25. to where that cap's no longer there heading into 26. So if you don't have a pass through and most of your income that's taxed at the state level, you're not able to use that pass through entity return to take advantage of that deduction still, but in a different way. That deduction will return, and the value, the federal savings tied to that will return in 2026. But if you do have a pass through, whether it's a partnership or an S corp that you own a business through, and you're able to do that pass through entity election in the states that you operate in, our position is that there's still value to do that. And because the second thing I'm going to talk about is the AMT exemption phase outs, because those thresholds to where AMT starts to apply increased under the Tax Cuts and Jobs Act. And when we get past 2025, they'll go to pre-tax and Tax Cuts and Jobs Act levels, which may subject more taxpayers to AMT. Well, how the state and local itemized deduction cap plays into that is if you don't elect into those pass-through entity returns and pay the tax at the entity level, and you're just paying them, at the individual level and deducting them as an itemized deduction, that's an AMT preference item. So it factors into those AMT calculations, and you may, end up paying AMT tax, and your effective tax rate ends up higher because of that. But if you elect to pay them at the entity level through your pass-through, those are not the way the law is currently written. It could change over time, but it's not currently an AMT preference item. So the preference there would be to continue to file those PT returns. Not only for that, but as I mentioned earlier, it's the simplicity in paying the tax, where if you have 5 to 10 shareholders in an S corp, you're paying tax once instead of having all 5 or 10 shareholders paying separate individual tax payments or estimates throughout the year, which is a lot more paperwork and kind of planning behind it. Another thing that changed with the Tax Cuts and Jobs Act, it capped the mortgage interest deduction for new loans to $750,000. And after 2025, the cap will return to the prior limit of $1 million. So there's an additional $250,000 of loan value. If you have mortgage interest on that, you can deduct that as an itemized deduction. Another change is the child tax credit, family credits. The child tax credit increased to $2,000 per child under the Tax Cuts and Jobs Act with a refundable portion. If those provisions expire and aren't renewed, it could revert to the previous lower value of $1,000 per child. I mentioned earlier on the pass-throughs, the 199 cap A deduction, the qualified business income deduction. Well, that's based on whether or not the business is a trader business or other definitions that fall under 199 cap A, but that's a deduction at the individual level. So that also expires, impacts the cash outflow from the pass-through, but it's really a tax payment due at the individual level.
Perfect. So, one of the comments that we've gotten through on the Q&A is all this is very confusing because we've talked about all different pieces, and I don't disagree. There's a lot of pieces that are coming together, and it is very difficult to navigate all the different options and opportunities that can be out there. How does somebody get started? Let's say someone hasn't done anything on estate planning. Sometimes the hardest place is to know where to begin. How and where does somebody begin? Any thoughts, Mark, Adam?
Yeah. So the first step is to contact your trusted Anywhere advisor. And then they can reach out to me, and then we can follow up. But what I use to kind of get this process started is I have a questionnaire, and in that questionnaire, the client not only lists out their personal information, birthday, address, all that kind of stuff, but whether they have current estate planning documents in place. We'd like to review those if they do, and then family makeup, kids, grandkids, where they live, where they're at in their life, and then an inventory of your assets and your liabilities to kind of figure out what we have to work with, and really through conversations, and through just talking through that questionnaire, we get a feel of what those objectives are of the client, and really where we need to focus our energies on, and what their wishes are. And that's kind of where we all start, is that questionnaire. So seriously, reach out to whoever you're working with at Brady Ware, and if you're not currently, reach out to me, and we can get that process started.
I think,
So, yeah,
sorry.
go ahead, Adam. Sorry.
It ties in. I just saw a question out there, which is important, and it ties into kind of what Mark was talking about. Kind of knowing where to go when you think about, transferring something now. If you have a beneficiary that, or I'm sorry, the person with doing the estate planning that, they're much older, they're maybe in poor health. Important thing to point out is that if you transfer the assets before they pass, you get a carryover basis in that. So let's say that the value is 10 million, but their tax basis in that over time is only 5 million. So there's 5 million of gain really built into that, and you're basically transferring that tax liability to the beneficiary. Whether you create it through a trust or however you transfer it. You're transferring that $5 million tax liability, where if that individual were to pass prior to the transfer, you get a fair market value step up on the date of death. And so that $5 million deferred gain is erased. So you certainly want to think about kind of where that is before you go and transfer. And that's something as advisors that we would discuss with you in that process. But it's a great question, and it's something that you certainly never want to plan for. You're not trying to plan the day for someone to die, but you want to know kind of what impact it could have if you maybe too quickly transfer when that step up is available. And I think the biggest thing we all think about, we kind of joke about, is that the IRS is the biggest investor in your business. They get their first cut. They get their cut first among everyone else, and so timing that really plays a big role in it.
Yeah, that's an excellent point. So speaking of timing, kind of tying all this together, if somebody really wants to get started on the planning process, what timeline are they looking like, or what are they looking at? Is it the same for everybody? I know that the answer we always joke also on this, is the answer always in tax is it depends. But, if we can give everyone a little bit of guidance on what kind of a timeline they're looking like, so from the time that they start to the time they have things in order, so they can just kind of get a sense from a planning perspective, when they need to get started.
Yeah, the earlier the better. So I would not wait until next November or December to really start thinking about these things, because not only do we as advisors have to do our part, and the client has to do their part as well. But if we're starting in, let's say, October, that really cuts the time of when we need that attorney to turn those documents around, for us to review them then, and for the client to review them, and then get them back to the attorney for any adjustments. All those assets transferred into that trust, all of that stuff takes time. Leave yourself that time. It's better to start earlier than the last minute, than later. I'm sure we can try to get things done for those last minute people, but I can't make any promises on, let's say the attorney that's going to draft the documents is backed up 2 months and we're going in November. That's going to be a tough sell. So you just think about all those different people that are involved and all those different schedules that are involved in that. And it would just be to their benefit to start earlier rather than later.
Right. And nobody ever wants to be in that spot where they're the job or the deliverable being rushed, right? Like usually nothing comes out of that other than just frustration.
Right.
So I would echo Mark's thoughts. Any additional thoughts on that, Adam? Other than sooner than later?
Yeah, I think sooner rather than later. I mean, I mentioned earlier how, as business owners, you can kind of be heads down, focusing on your growth and everything. But if you're still, kind of building your team and you're still extremely valuable, I mean, you mentioned life comes at you fast and things can happen. And the last thing you want to happen in any of those scenarios is for, any assets that you own to end up in probate rather than kind of knowing where they'll transfer, if you happen to pass, whether it's an accident or whatever it is. But just having those things in place to protect that value, because probate can be expensive, and getting it through that process, even if you kind of know who or the person who is expected to kind of step into that in the event that happens. It doesn't always go that smoothly, and the cost can be high to trying to protect that throughout that process. So just the earlier, the better.
Yeah. Not to kind of pin you, but I'm going to try to pin both of you, right? So since I can, but what are we talking about, right? Are we talking like a week? Are we talking 2 weeks? Are we talking 4 months? Just generalize, like what is some sort of a generalized timeline?
Okay. Yeah. So from my standpoint, it would be at least a few weeks.
Mhm.
So at a minimum, a few weeks, and everyone is different. Everyone's estate looks a little bit different, and this is
Right.
not a cookie cutter thing. So because we're looking at these individually, it really depends. And I'd love as much time as I can get, but we've
Right.
got a year and 2 months to deal with. So there's only so much time in each day. And if it's taken me a week or two to do a basic one, then that'll give you a pretty good indication.
Yeah. No, that's helpful. That is helpful. And I think it's helpful for our audience as well to just kind of know what, again, just general idea, ballpark idea for those that don't live and breathe this every day. So if it's okay, I know we've touched on a couple of questions that have come in. I'm just going to now throw some random questions at you guys, if that's okay. So the first one is, assume a donor makes a gift in 2025 of $1 million in cash to a child when the exemption is a 13.99 million. The sunset occurs on 12/31/2025, and the new exemption is, say, 7 million. Will the 2025 gift reduce the new exemption available by the $1 million gift?
Yeah, so they'll have approximately $6 million left to work with because they've already used that $1 million.
Yep.
I think
Another
important thing,
question. Go ahead, Adam.
sorry. Important thing there too, like on the flip side of it, if, in 2025, the exemption is 13.9, and you utilize all that 13.9, when it drops to 7 million, if nothing's renewed or anything, it's not like now you've exceeded that 7 million. You've locked it in. And that's what we're chasing, is the fact that it's available now, but it won't be in the future. So there's no like fallback of that just because it reduces in 25 or 26.
Right. Nope. Excellent points. Is a 13.99 million lifetime exemption per person? So like per donee or in total? So the example that's been offered in the question is, if an individual has 2 children, can he give up, about 14 million to each child, or is it 13.99 total?
13.99 total. So if you're a married person, then your spouse has the same amount as well. So it's person per potential decedent is the way to look at it.
Right.
Yeah,
Yeah, or I like to look at it per donor, right?
Yeah.
Yeah. The annual exclusion though, which and Mark, you'll have to correct me here on the annual amount, but I think in 24 it's like 17,000-18,000, somewhere around there.
So, 820.
Yeah, that's per person. It's not, so you could, if you had 100 people, and that's the amount you can gift per year, regardless of whether or not you've met the lifetime exemption. You can gift that per year tax free to a number of individuals. So that's still always there. But so that could be a way to gift more if you have a large family or something, or just in some way you'd like to gift others.
Right. The annual exclusion is per donor, per donee. The lifetime exemption is per person.
Correct. Another question, can I be the trustee of the irrevocable trust if I create one for my kids and still get the assets out of my estate?
Yeah, that's a tricky situation. Theoretically, yes, but you better have a lot of limits on you, and you better have other trust protectors to Make sure that you're not tripping up. I think it's like section 2036 and then code section 674, that you're not having too much control and too much dominion over those assets and when and who you can make payments to. So you really have to be careful on naming yourself as a trustee. Now, that doesn't mean that you're giving up complete control. You're naming the trustee. So if it's an independent trustee, say my trusted brother, who will do what I say. So, I mean, that kind of thing is fine. At least have that barrier. So the IRS cannot come in and say, you still have total control over these assets. You really, really have to tread lightly on those kind of things.
Yep.
And that Mark mentioned several times that irrevocable, when that term's in there, I mean, the terms of the trust are, created on formation. And if the trustee has too much control over changing those terms over time, especially if it's for self-benefit, that could be a big problem in being the trustee of your kid's trust.
Mm-hmm. Can you touch on the portability of the estate tax exemption?
Yeah, sure. So, as I mentioned, every person right now has $13.61 million of a lifetime exemption. If I pass away without using any of my lifetime exemption, and all of my assets automatically go to my surviving spouse, my unused lifetime exemption also goes to my surviving spouse. So it's called portability. Uh, I can die with it, and it transfers over to my surviving spouse. Um, but it's DSU. It's deceased spouse unused exemption. So yeah, you
There's
have to
another
file.
acronym.
Right, exactly. You have to file a 706, a form 706 to calculate the total taxable estate of the decedent and how much lifetime exemption they used as part of their taxable estate. Remainder of that is calculated on that form as well and goes to their surviving spouse. Now, the surviving spouse can use that for gifting purposes for their own estate when they pass away or whatever. But that exemption that's unused on that first to die becomes the surviving spouse's unused exemption.
Perfect. So we've got just a couple minutes left with everyone here today, and I know we still have some questions that remain unanswered. Again, I'd like to remind everyone we will follow up with you after the webinar to get any of those questions answered. But to help kind of tie this together, Mark and Adam, if you guys can give just a quick, maybe 45 seconds each, give me like a case study. So help, understanding everything is very dependent on facts and circumstances, but for our audience, helping them understand kind of what you've recently worked on with a client, what were the fact patterns, and what did you work through?
Sure. One of mine, a client has roughly $14 million, $15 million of total value in their estate. They don't have a surviving spouse. So we're not talking about using $27 million here. We're talking about using 13.61 million. So with a 5%, let's say 5% value addition every single year, that estate's growing by 5%. If we transfer that 13.61 now, after 5 years, we would be saving. And by the way, we're also proposing an IDGIT with a sale component in there.
Sure.
But what we've proposed is saving the client based on our projections, about $2.5 million of estate tax, just the next 5 years, just because that the appreciation being locked out of the estate and that lifetime exemption being cut in half. So there's my 45 seconds.
Thanks, Mark. Adam?
Yeah, I think good example, a business owner, they're in their mind, they're about 10 years out from retirement. And they're not really looking at, haven't considered what that exit looks like and how to get there. And maybe don't have like the current team in place. I mean, I think just having that conversation, looking at, we don't have to complete a full business valuation to kind of, we can look at, where your business is, revenue wise, taking a good look at EBITDA, because usually, and that's earnings before interest, tax, depreciation, amortization. There's usually, as far as the enterprise value, a multiple applied to that number. And there's, depending on the industry, you may have a higher multiple based on things that you're doing that are highly specialized that create a lot of additional value. But taking a look at that and seeing what that value is, a lot of times that's a shock. You don't, you know what your annual, revenue and what your profit is. You've got a successful business, but you don't realize the multiple that's applied to that. It can be realized in a liquidity event now, and may not even realize that this really does apply to you, because outside of your business, you don't have, as far as in cash or other assets, over that 13.6 in 24 or 13.9 in 25. You don't think you're there. But that may show you otherwise. And then because of that value that's there, maybe an earlier exit is appealing to you just from the day in and day out, just running a business and the stress and load that comes with that. So I think just having that conversation and thinking through it is a good start, whether or not this estate provision applies.
Yep, helpful. Thank you, Mark. Thank you, Adam. I want to thank our audience for sharing their very valuable time with us. At this point, I'll hand it back over to Bruce to help close us out.
Thank you very much, Anita, Mark, and Adam. We hope this was helpful and informative to everyone. On behalf of our panelists and everyone at Brady Ware, thank you for attending.